Hi everyone, Buyer's Agent Jay Pace here for Providence Property Group with a market update for the month that was September 2023. We're a national buyer's agency with offices in Sydney, Melbourne, Brisbane and Perth. We believe there is always an opportunity somewhere, and we help you to be a player and not a spectator in your wealth journey, focusing on quality properties over quantity, operating through 3 decades. Our experience will ensure no sleepless nights worrying about property markets. On this channel, we talk about all things property, but most importantly, I read the news and separate the fact from the fiction so you don't have to. Let's jump in. Now, last month, we actually broke down, I'm just going to move my head around a little bit today. Last month, we broke down the costs of delay per week. And the numbers are again higher this month with another month of increased price points. As of September 1st, we have seen prices increase in value by an average of more than $100,000 in Sydney, so that's $2,800 per week. So $2,800 per week is the equivalent to $150,000 income, by the way. $57,000 in Brisbane, which is the equivalent to $1,700 per week increase. $40,000 that we can see in Perth, which is $1,200 per week, and Melbourne, and I counted Melbourne not because of its positioning, but more because it is one of the major 4 capital cities, but it is definitely one of the worst performers. Melbourne's kind of in a time capsule at the moment. If you buy in Melbourne right now, you're kind of buying at the same price you would have bought in 2019. $28,000 increase, $800 per week. Quite interesting. Let's keep moving on. So, according to data from Domain, this is realestate.com, buyers take about 9 months to purchase property. And they know they've got all the data there. And this data is actually from 2019. I would dare say, with significantly less stock on the market, that 9 months is probably blowing out to about a year now. Okay? But 9 months is 273 days. Okay? And if you've got a pre-approval, that's 12 Saturdays, 3 months, 12 Saturdays to go and look at property. So this is definitely one of the reasons why a massive benefit of working with a buyer's agent like Providence Property Group is that we're going to turn that 9 months into 14 or about 30 days for you. So it's definitely going to be quite beneficial. Let's keep looking at the data. So this is the Hedonic Home Value Index. The September quarter actually saw Adelaide recording the highest capital gain at 4.3% for the quarter. And that's followed by Brisbane at 3.9% and Perth at 3.6%. And if you watch my video from September last year, you'll recall that I said probably the top 3 for the next couple of years is most likely going to be that Brisbane, Adelaide, Perth market. At the other end of the growth spectrum, we can see Hobart, their values are down 0.2% over the quarter, taking, that southern capital to a new cyclical low. There's nothing wrong with Hobart. I quite like visiting there, but in regards to an investment, not that fantastic. If we do focus on the annual return though, you'll see 7.3% for Sydney, which is actually second place. Tied here for Brisbane and Adelaide for the year at 5% increase in price. That's third place, but the golden child is definitely Perth, 8.8% capital growth, which is very attractive. Plus, we're looking at quite a good rental yield on there, which is nearly a 1-for-1. It's quite attractive, actually. Let's have a look again here at Australia's residential market. Now, we hit $10 trillion worth of value in June 2022, but values did dip. And that was because of inflation and obviously interest rate rises. The Australian property market quickly recovered, and now we've seen those values return to $10 trillion in June this year. So I think that's quite interesting when we see those prices. $10 trillion, it's just such a significant sounding amount of money, isn't it? Although that is a lot of money, I think it is interesting because we are a small fish in a very big pond when it comes to real estate. So according to Saville's World Research, real estate across the globe hit $591 trillion at the end of 2022. Now that's almost, and I had to Google this, 0.6 of a quadrillion dollars. Now I rarely get to say the word quadrillion, so I was really excited about being able to use it on this video today. Now, if we look at the total value of real estate, it's actually slipped 2.8% from 2021 to the end of 2022. To 390 trillion Australian dollars. But it's still 18.7% higher than pre-COVID levels in 2019. So that's a significant amount of money for property prices. It comes as little surprise that real estate remains the world's most significant store of wealth. Residential properties accounted for over 3/4, 76% of global property value. Residential property worth 450 trillion Australian dollars. So nearly half a quadrillion. Australia's property market is ranked 10th, actually. So if you want to look at, which country has the most valuable property, to no surprise to a certain extent, the People's Republic of China is number one and makes up just over a quarter, 26% of the world's real estate value as of 2022. And this comprises both residential and commercial real estate, actually. Now, the United States is second place, accounting for 19% of the global real estate value. And you can see we're just at the bottom there at number 10. I also thought this was quite interesting. If we wanted to look at how property compares to stock markets and other investments, to recap what I just spoke about before, global real estate is valued at 591 trillion Australian dollars in 2022. Now, global equities were valued at almost a quarter of global real estate value, so they were only valued at 156 trillion Australian dollars, according to Savills' report that they did. Now, debt securities were actually about a third of the value of real estate, coming in at 200 trillion Australian dollars. And starkly, Savills highlighted that the value of all gold ever mined was actually only 19 trillion Australian dollars. That's a 3% of the value of global real estate. Really, really interesting there. This is another interesting little table that I was looking at. I wanted to talk about perspective. I love talking about perspective and obviously looking back, and I think that's always an interesting way to live your life, is understand what happened in the past so we don't repeat those future mistakes in the future. So with that in mind, I just wanted to review property prices from 20 years ago. So 2003 actually. And where are they now? So in 2003, the most expensive city in which to buy a home was Sydney. For a lot of people, that's not a surprise. The median house price then was less than $500,000, $497,000 at the end of the June quarter for that year. If we had time machines, we'd all be billionaires probably. According to Domain data, based on today's numbers, that price has actually grown by 193.62%. So remember, it's not just timing the market, it's time in the market. So back in 2003, it was significantly cheaper actually in Canberra at $347,000, Melbourne at $314,000, and Hobart trailed the pack at $159,000. Now, according to the Australian Bureau of Statistics, 48% of homeowners actually had a mortgage between 2002 and 2003, and the median loan amount outstanding was only $96,000. That's the deposit most people are using today. Actually, it's probably a lot less than the deposit most people are using today. The average weekly cost for the mortgage and the property rates was around $246 per week. Now, roughly 53% of homeowners actually have a mortgage, so it's gone up from 48 to 53, so nothing too ridiculous. And the latest data from the Australian Bureau of Statistics pegged the average mortgage for owner-occupiers at $580,000. So that's 600% increase from 2022, 2023. So prices have jumped 216% over the last 20 years. So that's quite an amazing feat, quite unbelievable actually when you look at those numbers. So let's now have a look at the total amount of listings on the market. Again, I've been hearing a lot of media about, listing surge and all these properties are on the market. Look at those numbers. It's still 17.1% below the 5-year average, and we're still 11.6% below the same time last year. So in order for those media reports about a surge to be real, this would have to be significantly higher. And we're not there yet, and I honestly don't think we're going to get there. It doesn't seem like that's going to happen. So we continue to see rental vacancies drop. We're now more than 60% below the 10-year average at 1%. So it's quite significant. We're closer to 70% below that 10-year average at 2.8% there for the 10-year average. So no property for sale, no property for rent. What do you think is going to happen to property prices? Let's keep looking. Gross rental yield for dwellings across combined capitals is currently 3.5%, so that's continued to drop. With the average interest rate now, above 6%, it's no wonder why, we're seeing capitals like Brisbane and Perth continuing to attract investors and Adelaide, and I think we're gonna keep seeing that. Interest rates, let's quickly have a chat about them. I got a little excited this week because we've had another hold, the fourth consecutive period of maintaining the relief on mortgages. So economists of the major banks now predict really no further rises this year. ANZ, Westpac and CBA, I think it was with the exception of NAB, they said, we might see one more interest rate rise. So we will see. Better than the 4.75% that we saw back in 2011, and definitely better than the 7.25% that we saw in 2008. Again, perspective, very, very important. So let's look at the home value index data. Like I showed before, really interesting. We're seeing Perth obviously keeping that mantle as top performer, and I reckon we're going to continue to see that. All the data here is available online, so I'll put some of the links into the description below. But the forecast for Australian property from a lot of the larger companies is definitely that it's going to continue being on the up and up. Now, this is something I just wanted to kind of finish on before I showed you some examples. I wanted to talk about home loan resilience. I watched a few YouTube videos lately and read a few articles, and I think it's really important because this is not a sexy subject, but it's definitely an important subject because it definitely sells papers when they talk about the doomsday scenarios of properties going into arrears, mortgagee in possessions, etc. And I feel really sorry for a lot of people that bought into that narrative because it breaks my heart when I speak to people on the phone or I have a chat with somebody about buying a property and they genuinely missed out because they listened to the media that said, nope, everything's going to be for sale, it's all going to be cheap, market's going to crash, it's great. And they hold on to that hope that that could have actually happened and that they might have been able to get something at that great price. But it's a fantasy, it was a lie, it never happened. So according to CBA, and we look at the results here, their presentation and investors discussion pack for the year ending 30 June 2023, mortgage holders are when it comes to falling behind on their repayments by more than 90 days, it actually continues to trend below the previous 4 years. So if we look at arrears by state, we can see all the major capitals are actually trending down here in arrears by state. And here again, we can see just, that time by 90 days. And like I said, it's not really an unattractive looking number. And if we're to review their, troublesome and impaired assets, their TIAs, we can actually see that it's higher than the year ending June 2022, but it's still lower than June 2019 before all this craziness happened with COVID. Home loans in arrears have actually been trending downward since 2019, so that's quite attractive. Mortgagee in possessions are still incredibly low. We get lots of calls all the time for people saying, I'm talking to another buyer's agent, they only deal with mortgagee in possessions. Well, it must be a very few transactions that those people do because currently mortgagee in possessions percentage of accounts for CBA, as a matter of fact, are 0.02%, as of June. And they were up higher in 2020 in June at 0.03%. So again, not worried about that. Mortgage cliff, I think it's a load of baloney, as I've been saying for the past couple months now. So we've been really busy lately, actually. That's why I'm a couple days late to delivering this video. But I'm going to show you some great properties because we have been buying some awesome product lately for our clients. So we bought this firecracker of a property for a Melbourne-based buyer. Their strategy was simple: buy multiple purchases of positively geared properties with low maintenance in established areas. Meat and potatoes, but it made sense. Based on their high yield requirements and their low median budget, we focused on Perth, Western Australia, and as I've been saying, it's already been a really good performer lately anyway. Large 3-bedroom, 2-bathroom, 4-car space villa. Yes, you heard me, 4 car spaces. And did I mention as well that it's freehold? Yep, no strata. That's exactly right. So these are the type of properties that we really like. Low maintenance. This property was built in 2016, 7 years old, and we often see these properties at around that 7-year-old age that they get loaded by the owners because they've taken out the majority of the depreciation and tax benefits. That's what they needed. So now they're happy to kind of release that property. There's only 4 properties in this little estate of four terrace homes, 4 villas. So we picked it up for a purchase price of $350,500. I mean, what a great price. Rental estimate, about $500 per week. That will be around a 7.4% rental yield. Now, it's a great property. Every super fund should have one of these. I mean, I want one. I'm probably going to look at buying one before the end of the year. Now, we also had a Sydney client looking at a property in a high capital growth area. The client had a decent deposit and was also able to manage that negatively geared property with the payoff of being historically above average increase in property prices. So we were pretty happy with this purchase. What we ended up with was a beautifully renovated classic Queenslander home on a huge 615 square meter block, 4 bedrooms, 2 bathrooms, 2 car spaces, only 7.5 kilometers from the CBD. Yes, people, J to the power of 3, location, location, location. We got to focus on that. Now, we agreed on a negotiated price of $1,040,000. We're receiving a rental income of $800 per week, which is going to be around 4%. The property has a long-term average annual capital growth rate of 8.28%. So we expect the property to have an increase in value of approximately $1.3 million in 10 years' time. The client's very happy. We're looking forward to actually assisting them with their next purchase very soon. This one was an owner-occupier. Now, they had a low budget, lower than the median dwelling value, and they wanted to break into the Southeast Queensland market. We put in our thinking hat. We used our data research skills to locate a suburb which had started to kind of buck the trend of its surrounding suburbs in regards to growth and also median household income. So that was showing signs of gentrification. I know that's a buzzword, but definitely this area was gentrifying. We picked this property up for only $695,000. 34 kilometres south of Brisbane CBD. So we found this really functional 3-bedroom, 2-bath house with a fantastic large covered rear deck. It's a great quiet street location with parkland actually at the end of the street. So 644 square metre block, nice flat block as well, which is important because in Brisbane there are quite suburbs. So we're happy with this, really usable yard, easy access to the Pacific Highway, to Brisbane or the Gold Coast from this location. We expect some good things from this up and coming suburb, so we're wrapped with it. Last ones I'll show you. This was a purchase for a returning client. I think this is their 5th or 6th purchase, and the investor was already, they already got a decent portfolio, but they were looking for something actually a little bit higher potential growth, but wanted the safety net of stronger rent, and this pushed us to explore a little outside of our comfort zone. I would definitely say I've said on this channel many times, we don't do regional. We don't like regional. But again, this client's a great client. They bought so many properties and we were happy to kind of extend that full. But we believe we really found a great property and you can't complain on this price. So high yield, 1K from the foreshore. Location is experiencing a surge in population growth due to a new airport, an increase in employment opportunities with expansions at the Iluka resources and Alcoa mine, bringing more families and workers to the area, putting pressure on the rental market, predicting that this will grow quite well and probably going to continue to offer clients some good capital growth here. So again, we were happy to roll the dice on this one based upon the data that we had. 3-bedroom, 1 bathroom, 7 car space. Yep, 7 car spaces. So it's a 1975 brick house on a huge 764 square meter block. Plenty of development potential here, which is probably what the client's going to look at doing with it sooner or later, within more conditions to local shops, schools, and definitely the beach. And that's what I love about Perth. You can literally go 200 kilometers north or south, and as long as you're within 5-10 k's to the east, to the west coast, you get into the beach within 5-minute drive. It's pretty amazing. Considering here in Sydney, where I am for the long weekend, tried to go to the beach from the inner west, and it took me an hour and 20 minutes to stand on the sand from leaving my house, and I'm only in the right area, so it's not very far. We secured this for only $387,000. We're getting over 6% rental yield. This property was, as I said, out of our usual areas, but the client wanted to explore options further away from Metro Perth. We did our research. We've watched 2 specific suburbs actually fill up with West Aussies since the airport expansion in 2020, and we took the search there. We found high yields and population growth. The client agreed that this was a great opportunity to give, with great potential. With the last 4 years seeing around a 5% capital growth rate per annum, which is not bad at all. So we were really happy with this. So great purchase for that client. I had so many more to choose from, but I just wanted to give you a bit of diversity between different capital cities and different product types. Remember, we can't help you until you commit, but once you commit, we won't let you fail. So we are bringing two things together here: your desire to build wealth and our 18 plus years of buying property for clients as Providence Property Group. So for more than 3 decades, Providence have helped Australians open a life of opportunity through real estate, giving them the future that they want. And we buy unique quality assets in areas where demand definitely outpaces supply. And we focus on properties that appeal to a much larger market of owner-occupiers, that 70% owner-occupiers, not just that 30% investor. And we buy in the right capital city at the right time, guided by economic property cycles, and we buy the property which is uniquely suited to your situation, which will act as a springboard for your next wealth building stage. So this is how top performing investors build wealth, and this is how we want to work with you. If you would like to see more of what we do, jump on our YouTube page, check that out, hit the subscribe button and give it a like. If you'd like to further your education, you can download our ebooks, and the links are in the YouTube description below. I want to thank you for your time today, and I will see you at next month's presentation. Have a great day.